Trump recently imposed new tariffs again. The new set will be about 10% to 12.5% on 60 trading partners, and that'll cover close to 100% of U.S. imports. These tariffs are imposed under Section 301 that punishes countries that fail to prohibit or enforce bans on goods produced using forced labor. Many major trading partners of U.S., including the European Union, Australia, Brazil, and Norway, said the justification is unfounded. A quick background. Back in April 2025, that's when the highest tariffs under Liberation Day were imposed, but were struck down by the Supreme Court on February this year. Trump responded with 10% global tariffs under Section 122, but that has a limited short time span, which expired in July 24th this year. Some comments. The EU foreign policy chief pointed out that it doesn't make sense because Europe has strong employment protections and also the labor conditions are proper, so that's why all these accusations are not properly grounded. And same for Australia. Australia already has some of the world's strongest measures against forced labor and modern slavery. And one more comment which really makes a lot of sense. The proposed tariffs would do little to directly improve forced labor. Instead, it's Trump's strategy to win the wider trade war. But many actually say that the impact on the markets are not that high because the new tariffs are a replacement of the previous one, which also falls between 10% to around 12%. Recently, U.S. Treasury climbed even higher, particularly the short-term ones. Typically, markets compare the 2-year against the 10-year U.S. Treasury. Look at the chart on the right first. The green line shows the 2-year, and you look at the yellow arrow. That's when the 2-year yield started to move higher than the 10-year yield. This is what we call the inverted yield curve. But more importantly, investors who hold short-term U.S. Treasury demand higher returns to compensate for their risk that they commit to. That means confidence level isn't high at all. The main reasons are the renewed problems at Middle East again, which pushed oil prices high. Previously, it was hovering at $70, but now it's between $90 to $100 mark. Furthermore, U.S. labor data is strong. Weekly jobless claims fell to a level that points to low layoffs. That means the U.S. economy remains resilient enough for the Fed to focus on pushing inflation down. Some background is oil prices recently increased after the Houthi attacks on oil tankers near Saudi Arabia's Red Sea coast, and U.S. threatened to intensify military actions against Iran. Investors fear this further disrupts energy supplies, which eventually pushes fuel and transportation costs higher. Expectations of rate hike now has a probability of 82% chance in September. It was a low 52% a week earlier. If the interest hike happens, there'll be some downwards adjustments in the U.S. stock market. On to Euro area, there's some good news before the Middle East conflict escalated again. Eurozone business activities, the composite PMI, the blend of manufacturing and services activities, moved from neutral to expansion. Both manufacturing and services activities strengthened. New orders returned to growth. Input costs and selling price inflation eased. Germany returned to growth. That's very important. That's the biggest GDP contributor, and France's downturn became less severe. This stronger than expected PMI initially is positive for cyclical sectors, so the common ones will be consumer discretionary, industrials, and materials. But the recent renewed Middle East conflict will change the outlook, and hopefully not by a lot. Hopefully, the expansion in business activities will hold through this recently renewed Middle East conflict. Investors now expect the renewed energy and geopolitical risk will harm businesses in Euro area, and more importantly, that'll dampen household spending. That matters because household spendings typically accounts for slightly more than half of Euro area's nominal GDP. If households spend lesser, economic growth will be affected. On to European Central Bank and interest rate. Their most recent meeting was 23rd July, and they didn't change interest rate, holding it at 2.25% after the recent hike in June. But the remarks from the meeting show that the European Central Bank is a lot more hawkish than before. So there will very likely be an interest rate hike in September. Similar to the U.S., and because of the recent renewed issues at Middle East, oil prices moved from below $70 to around $100. And Euro area is a net importer of energy. They import a lot. The higher energy costs will certainly push inflation higher again. Markets are now saying there's a 95% chance of a quarter-point interest rate hike in September and another one in December, but if oil and gas prices fall, then probably the hike will not happen. After interest rate hike, borrowing costs will be higher. But the good thing is, banks will receive some supports from higher interest margins because banks price their loans at a premium above the baseline interest rate. For bonds, when the baseline interest rate is higher, long-term bonds' fixed coupons will look less attractive because the higher base risk-free rate will also move money markets upwards. So then when you compare money markets against the long-term bonds, the spread between the two becomes smaller, and so those bonds will look less attractive because of the additional corporate risks from the issuers. Lastly, typically when the baseline interest rates increase, the respective currency will also increase, but not for this case, because investors are more concerned about Europe's dependence on imported energy. There will be negative growth effects from the oil shock. Therefore, confidence level will drop, and that also means currency will not really do well. Moving on to Japan, inflation picked up recently mostly because of higher oil prices. Much like Euro area, and paired with the sharply weaker yen, that means there's much more imported inflation. The headline consumer price gained 1.7%. The trend is at the chart at the right. Even when we look at the core consumer prices, which excludes food and energy prices, it also picked up. That shows the spillover effect. And one more layer to look at is producer prices. Despite the subsidies from Japan government to mitigate the global jump in energy prices, businesses have seen a sharp rise in costs. Producer prices jumped 7.1% year on year. It's the highest since 3 years ago. Some background in terms of energy. Japan is highly dependent on imported energy, and the country meets over 87% of its energy needs via imports. That's very high. And in terms of value, petroleum imports increased almost 60% year on year. The quantity might stay the same because the price has gone up so much. That's why you see a 59% jump. And then yen had also fallen to a fresh 4-decade low. That means the imported products like oil, food, and raw materials will be more expensive for the Japanese. The impact on equities is mixed. Exporters will benefit when they translate the overseas earnings back to yen, and because most exporters deal in US dollar. But importers, retailers, transportation companies, energy-intensive manufacturers all will face higher costs. Household-oriented businesses will also be affected when inflation weakens consumer spending. The good thing is when the interest rate increases, that will provide a boost to the Japanese yen. On to Singapore, the Monetary Authority of Singapore unexpectedly tightened monetary policy for the second consecutive review. This time around, the adjustment was smaller than the previous one on April 14th. Singapore manages inflation by adjusting the currency, which is the Singapore dollar nominal effective exchange rate, the SGD. We'll go through that in the next slide. For some background first, inflation has been picking up even though it's still relatively moderate and within the central bank's forecast. Headline inflation gained 1.9% year on year, and core inflation gained 1.6%. But the MAS always looks ahead. Instead of reacting, they would prefer to be proactive. Here are the 4 key reasons for the tightening. Energy costs remain high. The increase in oil and gas prices is feeding into electricity, transportation, and production costs. Then, the Middle East problems still persist. No one knows when it will stop, and that also affects the supply out of Strait of Hormuz. Next, growth is firm. The economy grew 5.7% year on year, led by technology and AI-related semiconductor demand. This gives the central bank room to tighten without pushing the economy downwards. And lastly, which links to the first few points, inflation is expected to stay high all the way into early next year. So what's SGD? We went through this on the 22nd of April's session. It's the value of Singapore dollar against the trade-weighted basket of currencies from major trading partners. It's the main tool that the Monetary Authority of Singapore uses to manage price stability, inflation. Because Singapore's economy is so small but very trade-reliant, gross exports and imports of goods and services are more than 3 times of the gross domestic product. That means exchange rate has a much bigger influence on inflation than using interest rates like the US. Furthermore, many big companies in Singapore, especially the multinationals, often fund themselves through their parent company elsewhere or global markets, rather than depending on the local Sing dollar borrowing. So because the adjustment of the SGD was very small this time, the direct impact on Singapore equities should be limited. But more importantly, the move is to manage inflation. So when inflation expectations are anchored at a stable outlook, that supports bond coupons' real returns. And lastly, with a higher Sing dollar that partially cushions all of the imported costs from or in oil, natural gas, food, consumer goods, which will improve transportation and production costs and electricity and utility prices. Let's link today's topic to the market. This is not a buying guide. It's meant to see how global market trends affect different industries. So first one is the biggest gain out of the 4 here. AEM Holdings is a semiconductor company in Singapore. It's the direct equity expression of Singapore's economy growth driver. The 5.7% year-on-year economic growth was led by tech and semiconductor-related companies. Then number 2 and number 3, they're both banks and financial services, Mizuho and BNP Paribas. Both are seeing lending margins widening, higher interest margins, higher net interest income. Banks price their loans with a premium above their respective countries' government bond yields. Both central banks, Bank of Japan and the European Central Bank, increased interest rates in June. That's why both banks benefit and gained higher net interest income. And lastly, related to Trump's Section 301 tariffs, the trade barriers will protect U.S. commerce. Cleveland is the clear domestic production beneficiary. Tariffs make overseas foreign companies much tougher to operate in U.S. Consumers will then be directed to the domestic players more. For Cleveland-Cliff, other than the trade barriers benefiting them, the rise in their share price is also because of stronger pricing, improving volumes in third quarter, which more than doubled in second quarter.